Hi everybody, Thomas here at Rebel Income. Over the years, I've spent a lot of time studying the market and different investing methods. That meant talking to a lot of other investors and reading a lot of books. One of the things I started studying were Berkshire Hathaway's annual reports, which for decades have been written by none other than the Oracle of Omaha, Warren Buffett. Over time, I found myself gravitating to the methods he often describes in those annual reports, at least as far as a small average investor like myself could. At first, I thought it just made sense to learn from one of the most successful investors in the history of the stock market. Now, I'm still a long way from being as smart or as successful as Mr. Buffett, of course, but over the last decade, I've come to understand why Mr. Buffett's approach makes so much sense to me. In this video, I'm going to explain some of the things that Mr. Buffett does and that anybody else can do, no matter how big or small your account may be or how experienced you are as an investor. Now, before we dive in, I'd like to ask you to help me grow my channel by liking this video and subscribing to my channel so you can get notified every time I publish new content. I also have my Rebel Income Patreon page. I publish daily exclusive access content on this page, from stock reports detailing my analysis in search of the trades I publish for my trade alerts, to lists of underpriced dividend-paying stocks, and even weekly recordings discussing current open trading positions and current market conditions. You'll find the link in the description area of this video. Take a look. You can sign up for a free 7-day trial of any of my membership levels, and I know you'll find something that you'll be able to use in your own trades. Now, are you the type of person that really doesn't like following the crowd in any setting? When everybody you know is doing exactly the same thing, do you look for any excuse to do something else? If you answered yes to either of these questions, you're a contrarian, because going against the grain of popular opinion and trends comes naturally to you. When I began to recognize that I fit into this category, my study of Warren Buffett started to make a lot more sense. As an investor, being a contrarian means that you go against prevailing market trends and sentiment on purpose. When everybody else is buying, you'll start selling, and when everybody else is selling, you'll start buying. Now, that might sound odd, but it follows a logic that has proven itself again and again over time. The point in time when the majority of investors believe the market is going up is when they're fully invested with no purchasing power left. That means there is no more upside to be had, and that's when major bearish reversals begin. In the opposite fashion, when everybody is saying the market is going down, they'll have already sold out, meaning that the only place the market can go from that point is up. The fact is that some of the most successful investors in the market are contrarians. Nobody is as recognizable as Warren Buffett. Mr. Buffett has built his success by taking a largely contrarian approach, buying companies for Berkshire Hathaway that most people have written off as the dogs of the stock market, and then profiting from long-term price appreciation. A perfect example came in 2008 at the height of the financial crisis that spurred the Great Recession. While publicly encouraging investors to buy American stocks at what most people considered the worst possible time, he put his money where his mouth was, buying a number of U.S. companies at deep discounts. A good example was his position in Goldman Sachs, which increased in value by about 239% from 2008 to 2018. Another was General Electric, which increased by more than 322% from a February 2009 low to a peak in August 2016. Mr. Buffett sums up his contrarian attitude with a great quote: "Be fearful when others are greedy, and greedy when others are fearful." At its core, being a contrarian investor is really as simple as that. When everybody is happy about the market, that's the time to start thinking about booking profits and increasing the amount of cash in your account. That way, when everybody else is hating on the market and talking about how bad things are, you'll be in prime position to start picking up great companies at extreme bargain levels. Other notable contrarians include Mr. Buffett's business partner in Berkshire Hathaway, Charlie Munger, who's a brilliant investor in his own right. Another is Michael Burry, who bucked the market's bullish trend in 2005. His evaluation of subprime mortgages led him to conclude that portion of the market was overheated. He began shorting the riskiest portions of the subprime mortgage market, while the rest of the market was still pushing to its highest levels through most of 2007. His success not only allowed him to close his hedge fund to focus on managing his personal investments, it even inspired the 2015 hit movie, The Big Short. The caveat that has to be recognized if you're a contrarian is the fact that sometimes a cheap stock is cheap for good reasons. The market has proven itself pretty adept at pricing fundamental strength or weakness into a stock's price in the majority of cases. That means that disciplined contrarian investing recognizes that a stock at or near historical lows needs more than a depressed price to make a good opportunity. It needs evidence that the underlying business is stronger than the stock's price suggests. That comes down to checking the company's fundamentals. There are a lot of metrics different investors rely on. Here's just a critical few that I like to use to streamline the process in the Rebel income system. A pattern of growth in a company's free cash flow over the last year is a strong sign the company's profitability is improving. When free cash flow has weakened over the last year, an improvement in the last quarter is often a sign that the company has weathered a difficult period and could be turning a corner. A company's balance sheet is an excellent reference for their fundamental strength. Increasing cash gives management the flexibility to pay dividends, buy back its stock, and invest in itself through research and development or to pursue acquisitions. Comparing cash to debt gives insight into how heavily leveraged a company may be. Net income is the revenue that is left over any period after all expenditures have been subtracted. Comparing net income to revenue over the same period is an effective way to see how much of a company's sales is taken up by regular business operations. Comparing periods to each other, for example, net income versus revenue in the last quarter contrasted against net income versus revenue over the last year, is a great way to determine if a company is more or less efficient on an operating basis over time. The question of how much a stock should be worth compared to its current price is never far from a contrarian's mind. That's why the principles behind value and contrarian investing are so often viewed as the same thing. The fine line that smart contrarians and value hunters try to walk is reflected in another famous quote by Mr. Buffett. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This is a statement that recognizes the difference between a stock that's being beaten down for proper reasons and another that is simply riding the wave of bearish market momentum and investor sentiment. It's also why I put so much focus on the fundamental metrics I just outlined and on whether a stock's valuation metrics suggest a good value proposition is in place. I like to combine two primary metrics. First is price to book ratio. Book value is a metric that Buffett describes as the amount of money that would be left for shareholders if a company liquidated its assets, paid off its debts, and closed its doors today. Comparing a stock's price to that value and to its historical ratios gives a good idea of the ratio that the market considers normal. The next is price to cash flow. Just as with the price to book ratio, I compare the stock's current ratio to its historical levels. When the combination of these two ratios, price to book and price to cash flow, is below its historical norms, you can generally bet there's a nice value proposition to be had. If the company's fundamental metrics are also healthy, you have exactly the ideal Mr. Buffett likes to find, a wonderful company at a fair price. Now, in the interest of full disclosure, the fact that a company may represent a good value today and may be deeply discounted doesn't necessarily mean that the stock is poised to reverse and go back up again, only that the business is worth more than the stock's price currently is. Another element of contrarian and value-based investing that is required is patience, because in many cases you may buy a stock at a very discounted price and see the stock drop below the price you've purchased it at. It takes discipline in these cases to pay attention to the company's fundamental strength and make sure that the stock's price drop isn't tied to any glaring weaknesses in the business's overall operations. It also means that in many cases, holding a stock through an extended downward trend may take a matter of months and possibly years before the stock recovers to the price that you bought it at and gives you any kind of significant price appreciation. That's a level of patience that takes time to learn and to develop, but if you pay attention to Mr. Buffett's results over the course of his investing career, the method speaks for itself. My Rebel Income system borrows from the principles laid out by arguably the most successful contrarian in the history of the stock market. I actively screen for stocks in every market condition that fit the parameters I've described, and I share those opportunities with my members. If you'd like to simplify your analysis and stop worrying about trying to follow the herd for useful income-producing opportunities in today's market, go to my Patreon page and sign up for one of my free 7-day trials. What are the investing methods you've tried? What have you found to be useful, and what's been more difficult for you to work with? Leave your comments below and let's get a fun discussion going. If you like my content, go ahead and give me a like on this video and subscribe to my channel. Your engagement helps my channel grow so I can keep giving you terrific new content here. Thanks for your time. I'm Thomas. Happy investing.